Welcome to So Money, everybody. I'm Farnoosh Friday. It is Friday, July 17th. We have a lot of questions today, all over the place. Someone wants to know how to leave their job gracefully while quietly job hunting, how to move in with your partner and combine your finances without getting into a fight, insurance priorities for a young single professional, when to think about long term care insurance, and what to do with that old, empty, rusty 401k, that account that's just been sitting there after you switch jobs. If you're listening to this show, thank you so much. And I also have another offer for you. I am on YouTube. Hi, YouTube. Hi. I'm here just waving. I understand this is where all the kids are going to get their podcasts now. And trust me, this isn't a new thing that I've been told. I've been told this. People have been telling me this for years, and I have been just ignoring them. And I can't ignore them any longer. So here we are on YouTube. I would love for you to hop over and check us out. Check me out. I will be posting most of our interviews on YouTube and sometimes these Friday episodes, but it's the future. And here we are. Before we get to the mailbag, I wanted to share a couple things. First, a little brag. Many of you know that in my non existing spare time, I've launched a hyperlocal podcast, another one. So I now produce 4 shows a week, including So Money. I produce the Montclair Pod with my colleague, Michael Schreiber. We are 2 friends. We go way back to Columbia Journalism School. And 18 months ago, we decided to launch the Montclair Pod as a way to serve our community, do something fun, tell all of the great stories that are hidden in our community, and the news and the analysis, and sometimes breaking news. And we have done quite a thing. It turns out in 18 months, we have made money, we have won awards, we have changed the discourse and impacted the discourse in our town. And the Columbia Journalism Review, which is an industry publication, it's journalists covering journalists talking about the industry, they profiled us as a way to kind of tell everybody about our playbook, which is how to do hyper local podcasts and bring back local news in a fresh and relevant way. And we are very grateful for this spotlight. It means a lot coming from our peers. And I'll link to that in our show notes. But it's just maybe a sign that we're onto something. And how a side hustle might someday become a full time hustle, I don't know. But in the meantime, let's talk about money. This podcast isn't going anywhere. This podcast is only going places. As I mentioned, we're on YouTube now. As I mentioned too, we have a lot of questions from our mailbag, but the news was pretty heavy over the last 10 days when it comes to personal finance. And some stories that I really want to talk about right now include a Wall Street Journal piece about a new clause in prenups. And I love this. It's meant to protect the spouse who leaves their job to become the full-time caregiver. And so in the Wall Street Journal, a story about how more couples are adding what's called a quote, leaving the workforce clause in their prenups. And the idea is simple. If one partner steps away from their career to raise kids or become a full-time caregiver, the prenup automatically provides financial protections for that person. Why does this matter? Because, friends, leaving the workforce isn't just giving up a paycheck, right? It can mean missing out on years of raises, promotions, retirement contributions, social security credits, and of course, future earning potential. And if the marriage ends years later, courts don't always fully compensate somebody for those lost opportunities. I think this is the other thing. It forces the spouse who continues to earn a paycheck to really understand and put a value towards the partner who isn't working outside of the home per se or earning a actual paycheck. For too long, we have underestimated or not estimated any value for the caregiver in the home. But the fact of the matter is, the person who's earning the paycheck could not do their job as well for as long as they do with as much flexibility if it wasn't for somebody else at home who was doing everything else, right? To make everyone else's life function and operate and move smoothly. So these newer prenups can require the working spouse to contribute to an investment account for the stay-at-home parent. I was actually on the Today Show, was it last week or 2 weeks ago, talking about this, how it's important to open up maybe a spousal IRA for the non-paycheck earning partner. The paycheck earning partner opens up a spousal IRA, puts it in their partner's name, contributes to it from their paycheck, and now this essentially becomes a default retirement account for their partner who is the full time caregiver. These prenups are also guaranteeing a larger share of assets in the event of a divorce, providing annual payments tied to years spent caregiving, and even funding education or career training if that spouse needs to re enter the workforce after a divorce. Hallelujah. What I love about this trend is that it changes the conversation around prenups. They're not just about protecting wealth, they're becoming a financial planning tool that recognizes, as I mentioned, unpaid labor, and it treats the caregiver as an economic contributor to the marriage. So, long and short, if you and your partner are even thinking that one of you may someday pause your career to raise children, that is a conversation worth having before the wedding, not after. And the goal isn't to plan for divorce, it's to make sure both partners are protected if one person's career is put on hold for the benefit of the family. All right, let's talk about money annoyances. What annoys you most about money? Well, a recent New York Times article by personal finance writers Ron Lieber and Tara Siegel Bernard called Six Things That Drive Us Crazy About Money in America goes as follows. Okay. And this is so great. And it got me thinking about my money hangups. And I've got a few and I'm going to share them in a second. But Lieber and Siegel Bernard, they point out that we have an enormous amount of financial choice in this country, which can be empowering, but it can also make managing our money incredibly complicated, expensive, and exhausting. So here are the six things they say drive us crazy. And I agree with all of them. The first is tipping everybody. Everywhere. Now, I'm big on tipping. I think tipping is important, but tipping prompts on those screens when you're just like at the coffee shop buying a bottle of water, am I going to leave 18%? No, but they seem to appear in more places all the time. And sometimes before we've even received the service, right? It leaves consumers wondering, like, who are we supposed to tip? How much to give? And why are customers being asked to make up for wages that, frankly, the employers should be paying? That's an argument, right? Number two annoyance, paper checks. While checks have largely disappeared in many other countries, Americans are still mailing them to piano teachers, homeowners associations, and relatives. I mean, we had a plumber come to our house and when he was done, I said, "Great, I'd like to pay you. Do you accept Venmo, Zelle, cash?" And he goes, "I will invoice you." I was like, "Invoice me? Like you're here. Like why? I mean, well, you did the job. I believe it's done." And he said, "I'll invoice you and then you can just address the invoice." I was like, all right. So then, like, 2 weeks later, I got an invoice in the mail. Like, why didn't he bring the invoice with him then and there? Or just, use his phone to send me a quick invoice. He mailed it to me. And my only option to pay him was to send him a check that is also going to take another like week probably to get to him. So I don't understand this. Checks, they're slow, everybody. And also vulnerable to theft. I was a victim of this. Somebody got my bank routing number and my account number and started to withdraw money from my business checking account using false checks. So, not to mention, checks can get lost or delayed in the mail, but somehow they are still part of our financial lives. Okay. Third annoyance, the cost and inconvenience of moving your money. So, electronic transfers. Okay. They're supposed to be easier, but moving money between accounts can still take days. Consumers may also be charged wire fees or instant transfer fees just to gain faster access to that money that already belongs to them. And as the authors put it should not cost you money to move your money. Right? Number 4, filing your taxes. Of course, yes. How could we forget? The American tax system is so complicated that filing even a basic return can take hours, and taxpayers with business income may spend an entire day on it. Meanwhile, residents of several other developed countries receive pre-filled returns that can be reviewed and completed within minutes. Why aren't we doing this, America? Thank you, New York Times, for pointing this out. And then the fifth thing on the New York Times list of annoying money things, college costs and confusing student borrowing. Yeah. College is more expensive than ever in this country, and students are often expected to borrow enormous sums before they're old enough to fully understand the long-term consequences. Even the federal loan and repayment programs that are meant to help borrowers can be extremely difficult to navigate. And Ron Lieber, who is one of the authors of this article, he's been on this show. He's written extensively about student loans. He's got a lot of solutions as well. And you should listen to those episodes of he and I talking about merit scholarships and other sorts of methods to save money on higher ed, on So Money. Oh, and finally, number 6. It's not a 5 thing. It's a 6 thing. 6 things. Healthcare. Health insurance in this country is so convoluted that even understanding your coverage feels like a full time job. We have premiums, deductibles, copays, provider networks, unexpected bills, all creating a system that is just not expensive, but often almost impossible to explain. And what I appreciated most about this article is that it reminds us that money stress is not always the result of making poor money choices, right? Sometimes we have systems themselves that are needlessly complicated. And while we're at it, I have a few grievances of my own, a few things to add to this list of six. Number seven, managing my kids' allowances. Can someone please explain why this is still so hard in 2026? We use cash, coin jars, debit cards. There are chore apps. There are like a dozen ways to do this. And honestly, none of them feel easy or effortless. I just want to teach my kids the value of money without needing to become their payroll department, right? It's a problem. Second, credit card surcharges. This one has really gotten out of hand. I mean, I remember a time when stores would charge you a fee for using your credit card if it was under a $20 purchase. And I get that. Small businesses, these charges, these credit card fees that they pay can cripple a business. They can shut you down. But now I just feel like it's everywhere for whatever price point. And whether you're buying a coffee or you're buying, a $500 Michelin starred meal, I think that retailers are just like, we're adding this and period next. It's 3 or 4% of what you're buying. And it's almost everywhere today. It's become ubiquitous. And again, I understand that businesses, especially the smaller businesses, are trying to offset processing costs. But from a consumer standpoint, it just feels like you're constantly being taxed. And finally, speaking of taxes, I hate property taxes. I get them. I understand them. I pay them. We need them. But as someone who lives in New Jersey, I had to include this. Property taxes pay for important things: schools, public safety, local services. I'm not arguing against funding our communities, but every year that bill, just my mortgage, of course, it's a fixed rate, right? Interest rate goes down over a period of time as I pay down the principal, but everything else goes up. My insurance goes up, property taxes go up. And so, although I've lived in this same house for 6 years that has gotten older and I've had to repair it, my monthly carrying costs have gone up because of property taxes and insurance. So love New Jersey, don't love the property taxes. So Tara, Ron, if you ever decide to write a sequel, I would like to nominate these three additions: managing kids' allowances, credit card surcharges, and property taxes. And how about you guys? What's your biggest money grievance that feels uniquely American? Email me, farnoosh@somoneypodcast.com, or DM me on Instagram. I think we can probably create a much longer list. And finally, in the news, California has become one of the latest states to require personal finance as a high school graduation requirement. Beginning with the class of 2031, every student will have to take a standalone course that covers everything from budgeting and credit to investing and taxes. One of the districts, Fresno Unified, is already showing what this can look like. Students there are managing mock investment portfolios. They're calling credit bureaus to understand their credit histories. They're developing business plans, and they're learning practical money skills through real world projects. Teachers say the class is one of the most engaging electives they've ever taught because students immediately see how it applies to their lives. Wow. And by the way, California is now the 26th state to require a standalone personal finance course for graduation. And one more thing before the mailbag. In our local town here in Montclair, a money scam surfaced the other week. Here's what happened. A woman was approached by a young man to donate to his basketball team. She was exiting her car and he came to her selling candy. When she went to Venmo him, she asked him for his account name. He offered to show her, took her phone, and in that few seconds transferred $2,500 to his own account, and then he ran off. This is terrible. And this is not the first time that I've heard this kind of story. I remember reading about it in the paper. It happened to a woman in Bryant Park in New York. I think it was last year or the year before. So, word of caution: do not let anyone touch your phone when you're in public, a stranger for that matter. Okay. Our phones are essentially our bank accounts these days. They are our wallets. Would she have handed her wallet to this kid? Would she have given over her bank routing number to this kid? No. So the fact that you're handing your phone with your Venmo account open, unlocked, I mean, I don't want to say I told you so, but I told you so. All right, let's hit the mailbag. First question is from Carrie, and she says, Farnoosh, I've spent the last 5 years working at a nonprofit that I genuinely love. My boss has been an incredible mentor, and I've grown a lot here. But my husband recently accepted a job in another state, and we're planning to move sometime early next year. I've quietly started applying for positions in our new city, but nobody at work knows. I feel guilty interviewing behind their backs. Part of me wonders if I should give them a heads up now, since they'll probably need time to replace me. Another part of me worries that if I don't end up finding a new job, I'll have created unnecessary tension. So, what is the right move? All right, Carrie, first off, congrats. A new chapter, even when that's a little frightening, that's usually a sign of growth. And let me say this up front, feeling loyal to an employer, it's not a bad thing, but loyalty and strategy are not the same. Right now, you don't have another offer. You're exploring possibilities. And honestly, that's what you should be doing. You have to go through this process. Until there's a concrete decision to make, though, I don't think there's any benefit to telling your employer you're considering leaving. I would never do this. I would never announce to my employer, like, I'm thinking of leaving or I'm interviewing elsewhere until the time comes when I have something in my hand to really talk about. There's nothing actionable for your employer when you're doing that other than to start doubting you, right? Imagine telling your manager, I might move, I might get another job, I might leave 6 months from now. That uncertainty can change how people view your role, your commitment. They might hesitate to put you on a major project or start thinking about succession before there's a reason to. So rather than talking to them about anything right now, I would just get clarity on your stuff, yourself. Do you actually want to move? Would your timeline change if the right opportunity came along? Those are your first questions. And here's something else I'd encourage you to explore before assuming that you need a brand new employer. Could your current job come with you? I've seen this happen quite a bit. We live in a world where many organizations today are far more flexible about where you live than they were a decade ago. If you're a valued employee, it may be worth asking whether there's an opportunity to work remotely, transition into a hybrid role, or even help the organization expand its reach in a new region. But don't worry about having that conversation today. First, you want to get a clearer picture of your plans. Don't automatically assume your only option, though, is to resign. And let's say you do get an offer. What do you owe your current employer? Right? What do you like actually at the end of the day? You owe them one thing, and that is your professionalism, which means giving them reasonable notice, documenting your work, wrapping up projects when possible, and making yourself available to answer questions during the transition. That's it. It's a lot, but that's it. Could you stay longer if both companies agree? Yeah, sure. Could you offer to consult for a few weeks afterward? Why not? But here's where I want you to let go of the guilt. You are not responsible for making your departure painless. You're responsible for making it professional. Companies make business decisions every day. Their budgets change, teams reorganize, roles go away, new leaders come in. Your career deserves the same thoughtful decision making. And from my standpoint, one of the biggest lessons I've learned over the years is that nobody will manage your career as carefully as you will. Your employer is looking out for the organization, and you're right now a part of that organization. And so presumably they're looking out for you, but the buck doesn't stop with you. The buck stops with the organization. And keep that in mind, right? Loyalty is important. It's good. It's honorable, but it should not get in your way of managing your career. You have to look out for yourself. And so leave graciously, leave respectfully, but don't stay somewhere simply because you're afraid of disappointing people. Okay. Question number 2, Farnoosh, how do we combine our finances without losing our independence? So Maya has a question about herself and her boyfriend moving in together later this year. They've been dating for almost 4 years. She's 28, works in healthcare, makes about $85,000 a year. He's in software and earns closer to $140,000. We've started apartment hunting, and suddenly it feels like every conversation revolves around money. Who's going to pay for the rent? Should we split everything 50-50? Should we open up a joint account? What about vacations and furniture? We both want this to feel fair, but we're not exactly sure what fair looks like when our incomes are pretty different. Where should we start? All right, Maya, first of all, thanks for your question. This is a big time for the two of you, a big financial transition that you're on. And many couples are in this boat before marriage. Here's the mistake I see couples making all the time. They will spend weeks debating who pays for Netflix and groceries and paper towels and furniture without really talking about where they're trying to go together as a couple financially. So put those expense questions aside and ask yourselves a much bigger question. What are we building? Are we hoping to buy a home in 3 years? Do we both want to travel every year, perhaps? When is marriage on the horizon? Do one of you hope to go back to school? Going back to our first article that we talked about, if we get married and have kids, will one of us step back from our careers to become the full time caregiver? Your answers to these questions will shape your financial system. And from there, you can talk about fairness. And one of my least favorite pieces of financial advice is that every couple should split everything 50-50. Look, sometimes that works beautifully, but a lot of times it's very unfair. If one person is earning 80,000 and the other person is earning 160,000, asking each partner to contribute the exact same dollar amount towards every shared expense, it leaves one person stretched thin while the other one barely notices the expense. Right? That's not equality. Fairness often means each person contributes in a way that reflects their ability while still feeling like an equal partner in the relationship. So I encourage you to have three buckets of money: one that's for you, one that's for him, and one that is yours together, ours. The ours account is where shared expenses live: rent, utilities, groceries, all your Netflixes, maybe even those vacations, and everything else stays in your individual accounts. You don't have to ask for permission every time you want to buy your friend a birthday gift or you want to splurge on concert tickets for yourself. And you both have financial breathing room. And in terms of how you contribute to that joint account, it's a percentage of your incomes, right? Maybe it's 50% of your incomes. The importance is that you're both meeting that monthly tally, the expenses that you have, the pooled expenses that you have every month, taking an equal percentage of each person's paycheck to pay for it. I've been married for a long time. And one thing I've learned is that healthy financial partnerships are not about keeping score. They're about making sure that both people feel respected and heard and financially secure. So, with that, open up the conversation with that kind of empathy and respect and understanding. And don't have one conversation because it's not going to get done in one conversation. You got to have several conversations. But start now, start with a small conversation and build that momentum. All right, next question. Farnoosh, I'm single. Do I need insurance, life insurance? And if I do, what kind of policy actually do I need? This one comes from Alexis, who's 30. She's single. She's a renter and recently began her own consulting business after leaving her full time job. She does not have an HR department walking her through benefits, and she's realizing how much she needs to know about insurance, life insurance, as well as things like disability insurance and umbrella insurance. The list can feel long. So she's asking me if she was to build her insurance plan from scratch, what would I prioritize? And she doesn't have kids. Okay, this is a beautiful question. It's important. You got to think about insurance. And I would say that for those of us who have dependents, it's more imminent. It's more important to think about life insurance as a tool to support your loved ones, your dependents in your unexpected absence. If you don't have that, stop listening to this podcast. Go search for some life insurance. For singles in the audience, it's not as urgent, but it's still something to consider. And the simplest question I think we can start off with to kind of get to the bottom of things here is, what financial risk would be hardest for me to recover from without insurance? For someone who's single, healthy, doesn't have kids or anyone financially depending on them, the biggest risk usually isn't dying. It's losing the ability to earn an income. So your paycheck funds almost every financial goal you have, right? It pays your rent, your retirement, your emergency savings. It lets you travel. It helps you pay off debt. Your income is your greatest financial asset. And that's why if I had to prioritize as you, I would spend more time understanding disability insurance than life insurance. Life insurance exists to replace income for the people who depend on you after you're gone. If no one depends on your income today, you might not need a large life insurance policy right now. Since you don't have an employer, you might want to check with a professional association or a business organization that already provides a modest amount of coverage, and that might be enough for this stage of life. But disability insurance is a different conversation. If you get sick or injured, which then prevents you from working for 6 months or a year, how are you going to pay your bills? Could you fund that emergency account? Could your emergency fund carry you through it? Would you have clients waiting for you when you come back? Would your business continue generating income without you? And if the answer is no to one or all of these, then you really want to consider getting some disability insurance. And remember that disability isn't always the result of a catastrophic accident, right? Sometimes it's a chronic illness, it's the aftermath of a surgery or your mental health condition that requires an extended leave from work. And so it can be unexpected. And if you're self employed, it's even more important because there's often no employer safety net. If life throws you a curveball, the right coverage can be the difference between a temporary setback and a long term financial crisis. All right, two more questions. Next one, when should I actually start thinking about long term care? So, sticking with insurance, this question comes from Rebecca, and she's 41, she's married, she has two kids. And she says, Farnoosh, lately I have found myself thinking a lot about aging, not my own, but my parents. My grandmother recently moved into assisted living, and the costs have been eye opening. It's made me wonder whether my husband and I should be doing something now to prepare for that stage of life. Is long term care insurance something people should buy while they're still relatively young? Or is this one of those things that's better to wait on? All right, Rebecca, this is one of the financial topics that no one is thrilled to talk about. It's like I put it into the same category as estate planning and wills. We would much rather talk about, shopping or investing or even saving for retirement than imagining a future where we might need help getting dressed or bathe or living independently. But we can't ignore it. So many families, I think long-term care ends up being one of the biggest financial surprises of their retirement. And let's define what we're talking about. Long term care isn't the same thing as health insurance. It's not even the same thing as Medicare. Long term care generally refers to the ongoing help someone may need when they can no longer safely care for themselves independently. That care might happen in your own home through a home health aide. It might happen in an assisted living community, or in some cases, it could involve skilled nursing care. And Medicare was never designed to pay for years of custodial care. It can cover certain short term medical needs, rehab, skilled nursing after a qualifying hospital stay, but it does not generally pay for extended assistance with everyday activities, things like bathing, dressing, eating. So that's where families often find themselves paying out of pocket. So when should you start thinking about long-term care insurance, which would presumably help cover for some of this stuff? At 41 years old, you are not behind, but I also don't think you need to rush out and buy a policy tomorrow. For many people, their 50s are when this conversation becomes much more relevant. That's often the window where you're still healthy to qualify for good rates, but you're also close enough to retirement that the protection becomes more practical. That said, I do think your 40s are the perfect decade to become educated and learn how these policies work, what's covered, what isn't, because then by the time you reach 50, you'll be making a much more informed decision instead of a rushed one. And as far as paying for this, some people choose to self fund future care by building a larger retirement portfolio. They're like, I don't want more insurance. I'm just going to invest more. Others will purchase that long term care insurance. And then there are these sort of newer categories of products. They're called hybrid life insurance policies. So just kind of like how it sounds, it's a life insurance policy that's there for you in the event of your death for your loved ones. But there's a hybrid element to it where if before you die, you do need long-term care expense coverage, it can step in and do that for you. But there's no one size fits all answer. Again, important to sort of look at the marketplace, get educated, and let me know if you have any other questions on this because I'm actually making an appointment with a financial advisor to learn more about this specific aspect of financial planning, and I'll have more to share in the coming weeks. Last but not least, Farnoosh, should I worry about an old retirement account that's technically still open? So this is, a lot of us have been here. I've been here. This is a question from David. He says, my company recently switched 401k providers and everything transferred over without any issues. My balance is showing up correctly in the new account. The only thing that's bothering me is that I can still log into the old provider's website. The account shows a zero balance, but it's still attached to my name and social security number. I have the same situation with a 401k. You won't even believe, from 20 years ago. My first 401k that I opened is still showing up. Like if I log into the bank, I'm still banking with this bank, and my old 401k is still there. It shows $0 because I transferred the money over into an IRA when I left, or maybe it was my next 401k. Can't remember. It doesn't matter. And he asks, am I overthinking this? And, honestly, I don't like financial loose ends, old bank accounts, a forgotten rewards program, and your assets transferred. Your money arrives safely. Your job is done. Mission accomplished. I also, though, think your question is not just about your investments, right? It's about your digital footprint. And I actually think that's a smart thing to pay attention to. We do live in an era where cybersecurity is part of financial wellness. The more accounts that exist in your name, even the inactive ones, the more opportunities there are for outdated personal information to sit in someone else's database. So here's what I might recommend doing. You could contact the old provider and ask a few simple questions. First, is my account officially closed or is it simply inactive? Those are two different things. What personal information do you still retain? Do they still have your social security number? Do they have your mailing address, your beneficiary information, your employment history? And finally, can my online login credentials be deactivated? Sometimes institutions are required to retain records for regulatory purposes, so they may not be able to erase every trace of your account, but they may be able to disable online access or explain exactly what's being retained and why. And I would ask for these answers sent to you in written form, a written confirmation that one, your retirement assets have been successfully transferred, the account has been closed or deactivated according to their procedures. And listen, you're probably never going to use this document, but if you ever do, you'll be glad you have it. It's also a good reminder to make digital housekeeping part of your annual financial checkup. So once a year, I like to ask myself, do I know where all my retirement accounts are? Are my beneficiaries up to date? Have I changed my passwords recently? Am I still using multi factor authentication wherever I can? Have I frozen my credit with the major credit bureaus, which I did recently? These aren't glamorous financial tasks. Nobody's posting about them on TikTok or Instagram, but they're very important because it's not just about your money, it's about your identity and preventing any kind of unnecessary risk to your financial life. And that's our show, everybody. Thanks as always for your fantastic questions. If you have any that you'd like for me to address on a future Ask Farnoosh Friday, send them my way. My email is farnoosh@somoneypodcast.com. You can also go to Instagram and DM me there. We're also now on YouTube. Drop me a question in the comments. Until next time, everybody, have a great weekend. I hope your weekend is so money.